now. Good morning and good afternoon, everyone, depending on which time zones you're in. But yeah, welcome to Saxo's bi-weekly call. And I hope you found the session last time useful. So here we are. And in 2 weeks, I think it's really a good time gap to organize these calls because we do have some updated views to share here. So maybe let's just dive straight in. I'm sure you can already see my slides, right? So we'll just start with a quick summary of what really happened last week. Particularly last week, I think we did see quite a sharp turn in risk sentiment for the worse. And it was driven mostly by two things. So one was the China sentiment getting more and more negative. A lot of questions about the lack of stimulus, the slow stimulus announcements in China, and then also even if we did get some announcements on stimulus, on rate cuts, is that really enough? And the conversation now really shifting from the cyclical challenges that China was facing in terms of the growth challenge and consumption challenge to more of the structural challenges now, where we're starting to talk about the sustainability of the debt trajectory and what are they doing to kind of change that, make investments in more productive sectors. And Redmond's going to dig deeper into all of that with you later on. But the second key factor that really drove that change in the markets last week was concerns about US inflation coming back. So the economic momentum coming out from the indicators in the US has held up pretty strong, and that is obviously fueling some concerns about another leg of inflation, or particularly not so much of rate hikes coming back, but more so of interest rates being higher for longer, and rate cuts being postponed well into 2024. So that's also spelling some risk off. And both of these stories that have been playing out in the markets over the last week, they get a test this week as well. So again, China, Redmond's going to discuss more on that later on. But for the US inflation story, I think we have a lot of things to watch this week, and particularly again next week we get a lot of key data, and we're going to dig into all of that as we go through the slides here. But yeah, particularly highlighting here the sharply lower equities and the sharply higher bond yields. So we had a sell-off both in bonds as well as in equities last week. Commodities also broadly lower on the back of some gains in US dollar, but just a broader risk-off move as well. And in the FX space as well, like I said, yeah, broadly higher US dollar because of a safety bid that is coming into the picture, and also a lot of demand for carry. And again, I'll touch upon that as we go through the slides. But moving along, we have this big change in economic outlook. So at Saxo, our team is actually changing the outlook for the US from non-recession. We've actually been sticking with the idea that US will avoid a recession despite the interest rate hikes that we've seen so far. But now we're moving away from that, and we are calling for a stagflation. Stagflation meaning that economic growth will stagnate and inflation will continue to be higher than the expectations. And this certainly has consequences for our outlook for interest rates, for equities, for every asset class, right? So and why are we really changing this outlook? It's certainly the key reason is the rapid tightening that we've seen so far. I mean, if you look at all of the backward-looking data that we usually get, GDP, employment, and all of that, I mean, it's all suggesting, like I said, at the start, that everything's suggesting that the economy is really holding up quite well, and that is causing more inflation concerns as well. And the chart on the left side here from Bloomberg, the black one, it shows that Fed expectations have actually moved hawkishly. So the curve has shifted higher. The green line is the one that represents the current Fed pricing as of the end of last week, compared to the dotted yellow line, which is 3 months back. So we've moved higher. So interest rates are expected to be higher. But that, again, does does it take into account all these coming economic risks? So far we've only seen weakness in the manufacturing side of the U.S. economy, with PMIs, with goods inflation, or with factory orders, that kind of data. But consumer confidence, that has been quite strong, and other consumer data, other data relating to the economy has held up pretty strong. Now, but we are seeing increasing risk because as this rapid tightening passes through the economy, I mentioned this last time as well, there is an increasing wall of debt maturity that is coming, that we have to face in the next few years. And banks are tightening lending standards as well. Now, when that happens, that can impact the consumer side of the economy as well. They so far the consumers have held up because they had a lot of savings after the payouts in the COVID-19 times. Now those savings are supposedly running out. Also, I think the student loan forbearances that were announced, they're set to end in October this year. That will mean about 40 million Americans will have to start paying an extra $300-400 per month again, which again takes out some amount of money from the consumption wallet, and means some bit of a loss of purchasing power as well. Sorry. At a time, when the tightening is passing through, you have risks to specifically the high yield sector. I mentioned that last time as well. There are risks of delinquencies, risks of bankruptcies, specifically in the high yield sector, which could disrupt the labor markets as well. At the same time, you have these other factors of student loan forbearances or of pandemic savings running out that could be a constraint on consumption as well. So we need to, I think, continue to monitor this, but we are going to see, we potentially think that this is going to impact the economy in quite a significant way. But at the same time, now we are seeing disinflation trends in the US driven by weakness in demand, some easing in supply chain pressures as well. But we think that it is increasingly unlikely for inflation to reach back to 2% levels, which is the target from the Fed, because the labor markets are still tight, because the supply chains are still fragmenting, and in this fragmenting world, that's the whole supply chain rejig that's happening will cause inflation to settle in higher as well. And then we have these huge demands from green transformation as well, that again means that inflation will continue to be higher. And that's why stagflation light, that is our call for the later in the year, probably early next year. And just to be clear, we do not expect a stagflation-like scenario that played out in the 1970s or the 80s. It was, that was pretty deep stagflation. So there's no reason to really panic here. But this is a light stagflation call, which just suggests that there may be downsides ahead for portfolios, and we need to kind of should be ideally be prepared for those scenarios, either through diversification or protection strategies. These are some of the things that could be considered in the light of the growing risks to the US economy. Then moving along to what to, particularly on the macro front, what to watch in the markets in the this week or maybe next week. So I think two things, like I said, what's been driving the markets turnaround last week was the US interest rates, or the inflation story, higher for longer. And this week we get the Jackson Hole meeting, where Fed Chairman Powell is speaking on Friday at 10 a.m. ET. So probably if you're in Asia, it's going to be nighttime for you. So what could he bring to the table? I mean, that could again be a big mover for the bond market. It could obviously, again, that could filter through to the equity markets as well. Now there are obviously many different takes on what he could see, but I think the signals for the September meeting would potentially be very little, because there's a whole lot of data, and we've put in an appendix at the end of the slides, which kind of tracks what data is due over the next 2 weeks. You would see the US inflation data, the PCE metric, the is NFP. Both of those are due next week. And then we get the CPI as well on 13 September. All of these three data points are extremely key to Fed's decision making, and they're all due before the next September meeting. So it's really hard to say like whether we get a hike or not in September. And I don't think Powell would want to commit to anything right now. And again, I mean, these kind of meetings that we have, these have a more longer term focus. I think the theme for this year is also about the structural trends that are shaping the global economy. So the question would really be about, maybe there's some stories rolling around whether he's going to talk about what's the neutral rate and things like that. But the key question that investors are looking to get answered is that how far he can push the easing. Now that we're talking about higher for longer interest rates, markets are only pricing in rate cuts to begin in the middle of 2024. Does he sound a little bit concerned about the economy, like we've raised, right? Concerns around the credit risks, or consumption maybe taking a hit, labor markets maybe kind of taking a hit because of bankruptcies and stuff. Does he give us any hints of economic concerns, or of concerns around banks tightening lending standards? Now that could bring easing expectations to move forward a little bit. Or does he continue to kind of beat the drum on inflation issues and stuff like that? And that kind of, I would think the risks on that side are a little bit lower, because that still does not prompt the markets to start to price in a September rate hike. So I think, that's one thing. And the second thing to really watch is the China measures to support the economy. The big question, again, like I said, whether stimulus is enough or not. And we've seen the Hong Kong Stock Exchange down by over 20% from the Jan peak. So it's in the bear market territory now. And I think that continues to be the big question. So maybe I'll just stop here. I took a long time, and pass it on to Redmond to cover the China story.
Hi, thank you, Charu, and thank you for everyone to joining us today. Before we go into China, we just want to add a little bit to what Charu has touched upon, our stagflation light scenario, and also on the what she just mentioned, our house rule saying that inflation rate, yes, is moderating, but it's not going to come down to this kind of 2% target in the coming years. And so what I have on this screen for everyone to look at is this is basically a 147 years of history. It's not done by me, and it's done by some scholars, and they took the histories in the major market, US, UK, Germany, France, and Japan over the last 147 years up to 2021, and they divided the different period according to the inflation rate at that time, the average inflation rate over all those economy. And so I highlight the part in under 2% to 4%, and because we are exactly, we are now calling for a stagflation light scenario. That means inflation will still be high, but it's not that kind of hyperinflation. Like it's not going. We are not calling that will bounce back to 9% as in the earlier of the last year, and but it's around 4%, and so. Probably, if you look at this, and then I think we can take some comfort on it over the long run. And equity on nominal term, the nominal return is 11% for equity, and bonds not that bad, 4.5, and the typical 40% equity, 40% bond for 60-40 portfolio, and generate a decent return of 8.4%. And the most comforting part, of course, is even after we taking into consideration of the rather high inflation, we still have a real rate of return in equity of about 8%, and a 60-40 portfolio, we still got 5.6%. That seems is a kind of good news, or the triumph for the optimists, for the equity investors and bond over long-term investors. And And then, but of course, is well, if you look at when once we on the right hand side, if inflation's really getting really nasty, and the real rate of return will be much worse. And then if you look at the next slide, and this is a combination of actually the worst case scenario that is not as, I mean, that is more severe than our base case stagflation light scenario. That is actually outright severe stagflation. You have a high inflation, above 4%, and then you have a recession. NBER, as you know, is the National Bureau of Economic Research, and that is the institution that define whether that particular period of time in the US is a fall into recession. Of course, this is retrospective. I mean, they can't do it on real time, but they are the one, the most of the authority. Everybody look at um, for whether that is a recession or not, historically, not at the real time. But if you look at here, when once the combination of a recession and a inflation much higher than 4%, and not that was not very good for investors. And for equities, it's in nominal term, there's a loss of 7% on average. This is not compound, this is arithmetic or average. And for 60-40 portfolio, is negative 2.2. And bond a little bit better, 5%. But usually the interest rate, I mean, the Fed usually we have a central bank globally we raise interest rate. Having said that, I mean, even for bond investors, it's not really that good, because it's once you take into consideration of the high inflation rate prevailing at that time, real rate of return, well, that is what we actually should be caring for. Should care about is all negative. I'm saying in real term, equities is a negative something like 17%, and 60-40 portfolios is almost 12%, and even for bond, you are talking about more than 4% losses in real term. And once you take into consideration of for the inflation, so that is a risk we should be monitoring very closely. Not our base case. We will still think that now, or even in especially in the long run, we should be investing. We should stay invested, but we have to be vigilant about the risk towards early next years, whether recession will turn out to be more severe or inflation bounce back to actually more than the 4% we are forecasting. So at the moment, we need to stay nimble and tactically more defensive, but we want to stay invested. So look at what we can invest it, and in U.S. equity, we do that. Is a more recent history. That's only really looking back. This is done by my colleague Peter Gandhi in Copenhagen, and he looked at the history from 1989, more recent history, and look at the time when we have a combination, I think 3 or 4 occasions around those very brief occasion of those deflation period, and which sectors in the US did actually outperform. And healthcare and ranked at the number 1, and then followed by consumer staples and utilities. Energy doing not that bad as well. Also outperformed the S&P, even though it's still negative return. Yeah, I mean, so that means is that even though in the medium to longer term, we are more bullish on things like technology or commodities, but in the very near term, in the coming months, especially after the sharp increases in stock prices, and the valuation become quite high for technology stock, and also given the risk of, if our base case is not bad enough, I mean, that is even if it turn out to be more severe, then maybe we should position at least some of the portfolio, part of the portfolio can diversify, taking some profit or using some option strategies to hedge some of our gain in the technology stock. And by the way, our colleague Cohen has been issuing quite a lot of research lately on option strategies, focusing on how to protect some of our profits. So take a look on those. We don't have time to go through those, but go to our website or platform. You can find that those research there. And so coming back to the stock investment, so stay more in the defensive is the message for us for the coming month. And now, okay, now as we promised, we go back to China to take a look. Yeah, and I think we just don't want to. I mean, the market has been waiting for a big stimulus program or package from China over the last few months. Every time the number came out, not as strong as people expected or wished to be, and there's a lot of talk about stimulus. I think those are very targeted or kind of a more very focused stimulus. Yes, those will be coming, but more likely more on providing liquidity on the monetary side. Probably will be just providing liquidity to avoid any systemic risk. And for the fiscal side, probably will be more like industrial policies, which is to support particular industries, especially those more productive ones like industrial tech and so on, that China want to stay competitive or to become more competitive. And but for very big kind of stimulus like the thing happened in 2008 and 10, is our sector view that is not going to happen. And so that's why we have the headlines that investors should not wait for the stimulus dot is not going to come, but we should take actions to look for stock that probably that's industry that can benefit from the political tailwind on some industry. Why do we say so? And because since 2012, 2008 and 2010, China not just spent 4 trillion, but it actually more than that. And it's more than 75% of that actually bought by the local government. The local government have no revenue. They gave most of the revenue to the central government. They rely on land sales and they rely on borrowing. Theoretically, they cannot borrow. They cannot run a deficit, but they issue some bond on. But they also run into the sort of deficit through those financing vehicle, local government financing vehicle. I mean, they can borrow, but they cannot run a deficit. But in fact, they did, because they use those all-balance sheet vehicle to borrow from the bank. So 2016, I mean, it's and the bank, and they also lend through the shadow banking system through a lot of those what they call the trust company, and then to lend to developers and so on. So in 2016, the Chinese government already said, we need to stop that, and they actually have an article said the tree cannot go to the sky, and so China actually started a deleverage program starting from 2016, first on shadow banking, and then on property developers, and then the third on local government financial, local government debt. All these three today is still is still the problem. I mean, we heard a lot about problem on the stock developers. We now since last week we heard about the trust company, the wealth management product that is the shadow banking system. And then we also heard a lot about the local government debt. So the Chinese government need to handle those and address that rather than to do a big stimulus. So that's why we think that is they don't want to do anything very big. And then why we like some of those like computing power, industrial tech, and agri-tech, because it's China. If you look, this chart is the total factor productivity in China. I mean, for a country to grow, to increase the growth potential, yeah, you either add more labor, you add more resources, or you have to become more productive. It's not to print more money. I mean, print more money is only for cyclical cycle management, not for your growth potential. And so the China's total factor productivity has declined from over 4% in 2006 all the way to 2.5 even before the pandemic. So the real growth rate for China, potential growth, actually has much lower now. And so that means is that China, that the number one is really to improve on productivity and make food innovations, food science, food better organization of the industry. So that's why I think we think that they want to be. I mean, that's on top of what they want to be technology self-reliant. So industrial tech, agri-tech, and those are important. Computing power very important for the internet. Is rather than just consumer facing internet business, but the internet that actually can be internet of everything, that can help manufacturing, and those things will be very important, and those will have a tailwind support from the government. Uh, and then the very lastly, I touch upon to diversify the portfolio. Since 60-40 portfolio seems working again, and you take a look on those short-term treasury. At around 5%, we don't. We are not saying that interest rate will come down a lot, but the thing is, at 5%, that's above the current inflation level, and also above the inflation rate we are seeing. Even though inflation rate is not coming down to 2%, but it's only around 4%, this still provide you around a 1% real interest rate. It's a good way to diversify your portfolio and also generate some yield. And then we are calling from rate cut for maybe end of in the fourth quarter or early next year. So if there's rate cut, of course, the 2 year will tend also do pretty well. So and then this one, I'm not going to spend time here. And just if for those who are interested, more worry about inflation, talk to your contact here at Saxo. And for those tips, Treasury inflation protected securities is one of the things we propose, especially for clients that their portfolio are more exposure to the risk of inflation. If inflation really going to hurt them, or they think the inflation is going up, then look at tips that will compensate for your loss in inflation. I stop here, Charu. I hand it back to you for Forex.
Thank you, Redmond. Thank you. So yeah, I'll be really, really quick on FX and commodities, because I really want to spend some time on the final slide, which is about, summarizing how to invest in a stagflationary environment. So FX, we've seen the US dollar run higher last week, like I already mentioned, and we do see that the stagflation call. Could you please help to share my slides? If I don't think my slides are visible right now. I'm sure we'll get that up in a few seconds. But the US dollar potentially could be bid in the short term because of this stagflation scenario. What that really means is that the path for central banks becomes really complicated from here, and that. It's very hard for them to either respond to growth or inflation pressures because we have both at the same time. This means that the downturn that actually started for the US dollar back in July could be disrupted. That was driven mostly by disinflation, and that could get disrupted, and it'll have to potentially wait until we really see that turn in Fed policy. Like Redmond mentioned, we do expect them to start cutting rates in light of the economic risks and credit risks that we are highlighting in Fina's stagflation call. But again, unless we see that turn from the Fed, it's potentially going to be too soon to call for a downturn in the US dollar. The other benefit that the US dollar is getting right now, and that could continue, is from the carry trades. So what is a carry trade? Is that you borrow at a low interest rate and then you invest that in a high interest rate. And a lot of these carry trades usually work in a low volatility environment, which is what we have right now. The most favored funding currencies are Japanese yen, Chinese yuan, and Taiwanese dollar, and those can still be used. Japanese yen still continuing to be under pressure. There's hardly a scope for BOJ to kind of make a big tweak to its yield curve control policy. Chinese yuan as well, under pressure because of economic concerns and because of whatever stimulus measures we are seeing as well from the Chinese authorities. So these could continue to be the funding currencies, and the carry trades can continue to keep the US dollar in favor for now. And in terms of commodities, again, I mentioned it briefly, but there's a tough environment in the short term because, of the higher dollar potentially and a stagflationary scenario where you do expect demand contraction, and interest rates have to be held a little bit higher. Crude oil is particularly interesting because it's really towards the end of the range. It's been quite range bound since the start of this year, and it's now close to that top of the range, and has been rising because of some supply constraints or issues, concerns about tightness in the supply tightness in the coming months. But those seem to be easing as well now. and demand continues to be the demand outlook continues to be weak in light of the stagflation scenario. So again, potentially short term, it could keep in that range as well. So I think as long as we don't see the Fed shifting gears to an easier policy, it could be difficult for commodities for now to outperform, except energy in terms of equities. Again, that's because it is really one of the cheapest sectors in the economy, and on a structural basis, there's a lot of potential there. So just wrapping it up here, and this is the final slide. Can I please once again request for my slides to be shared? I don't think my slides are up, and this is a really interesting slide, so I would want the audience to see that. Okay, thank you. I see it now. So yeah, so this is the slide. This is basically a summary of everything we discussed on the call today. And if you please have questions, I'm sure there's a prompt somewhere on your screens, and you can send us your questions. We'll try to take some of them before we close for today. Yeah, so the slide really talks about how to position in this stagflationary environment, potentially. I mean, like Redmond said, on the equities front, we are looking at defensive positioning, which means there could be, it could be worth looking at consumer staples. It could be worth looking at utilities, healthcare. Oops. Okay. Perhaps you can see it now. So I think from an equities standpoint, you could look at those defensive sectors, and energy is also interesting in a stagflationary environment. Although, like Redmond showed history, it could still generate negative returns, but it has been outperforming the S&P 500 in times of stagflations. And you could obviously look at bonds, specifically government bonds, in the short and medium term. You stick with quality bonds because this is going to be a tough environment, but bonds help to diversify your portfolios, and tips could be interesting as well if that stagflation call plays out. Besides that, we can have, I think what we're really encouraging clients to do right now is to diversify and get some safe havens in the portfolios as well. So some of the ways to diversify, we've discussed that again last time as well, but we are talking a lot about the potential in Japan and in India markets on a structural basis. So these are some good options, I think, to diversify your portfolios. China story, as Redmond has discussed again, is a very, it's a very tactical and a very selective story. So sectors where there could be productive investments, that's where the focus of the Chinese authorities will be. We are not expecting a massive stimulus, so potentially consumption stocks and stuff like that could continue to underperform for now. And of course, the other safe havens being some of the investment metals like gold, for example. And of course, lastly, I mean, if you're speaking with traders or more advanced market participants, then the other ways to hedge your portfolio risks would be by using option strategies. Some of these could be just buy a put for a position to kind of limit the downside. You could also enhance the yields of your portfolio by using some other option strategies like covered calls or cash secured puts as well. So you can earn some yield while the market is going sideways or down, and that could kind of help to offset some of the losses if you are making some losses in your key base positions as well. And yeah, I think we'll stop there. We've overrun a little bit, but you will be able to get a copy of these slides later on through your salespeople. And I don't see any questions on the chat, but of course, if you ever have any questions, feel free to kind of reach out to the service managers and your salespeople, and they can also always put you in touch with us to kind of help you answer any questions or find any strategies for your portfolios. And I guess that will be it from us then. Thank you very much for joining. Okay, bye.